Okay, welcome everyone. Good morning. Let's we'll start our lesson two. Today lesson will go through our LO2. As a couple of you know me, my name is Anjum Sattar. Please, if you have any question, drop me email anjum@ukversity.co.uk. Today lesson really is about the critically analyze the financial performance of business, which will go through financial ratios, how we can measure the performance of the company. The key command verb today analyze apply we can recommend the people to invest in these companies based on the financial ratios. We'll discuss about the financial statement estimate exemption relating to the profit and loss accounts and the balance sheet and the cash flows. We'll discuss about the financial ratios, how we can measure the financial performance by using these ratios. Major four types of ratio: profitability, liquidity, use of resources, and gearing ratio. Those will be the key in our lesson. We'll do a bit recap what we learned during our last lesson. Recap. Lesson one. So during last lesson our focus was costing system. We had discussion about costing fixed costs which stay the same, like the rent rates, uh, those won't change, like a council tax is stay the same for a whole year. Then every end of the year, of course, it can change, but it's fixed for the certain period of time. The cost which remain the constant, it won't change for the certain period of time. Like if you're living 1% in a house, or you're living 3% in a house, if the house is rented by full house, it will be the fixed cost for the house. Okay, so second cost is variable cost. The cost will change with the level of output or level of activity. Like if you more people living in a house, you're using more water. So if it's a water meter, then of course the cost will go up. The bill will be more. If you're using more energy, then of course the cost will be more. It's a variable. It's change with the level of activity. So that's a variable. Semi-variable, semi-variable cost, which is known as fixed and variable together. Like if you have an IT contract with IT company, maybe you're paying the monthly fixed fees to become a member of IT company, and each time you raise the ticket or query, that's you pay variable cost. The cost will change with the level of output. That is a variable cost. Good morning, Sam. Are you okay? How are you keeping? Good morning. Can you hear me? I hope so. You can hear me. Good morning. Okay. So we are looking today really is about we recapping what we learned during our last lesson. So please, if you have any question, you can ask. So fixed cost, the cost will stay the same. Variable cost, the cost is changed with the level of output. Semi-variable, which is fixed and variable together. Then we had a discussion about step costing. So the cost is a fix up to certain level, up to the capacity level, and then it's increased. So like in a house, maybe we can fit 5 people, but if we have a 7, so we have to rent one more house. So that will be the step fixed cost can go up again. Is a fix up to certain level. That is it's known as a step fixed cost. The next costing we discuss about direct cost. The direct cost is also known as the cost which is a traceable, like we discussed about material, direct labor, directly involved in the production, and these were that are any other related direct costs, like a machine was directly involved in the production, and the machine cost can be direct cost. Okay, then we had a discussion overhead. We added overhead is the indirect expense. Direct costs or indirect expense, which we can say. So if we add them together, direct and indirect, we can say the production cost. Then we have a non-production cost. Then we can say what is non-production cost, like is the selling and distribution cost. here. If you're distributing good admin costs, so these are known as indirect non-production costs. So we can say what is the total cost of manufactured goods, and so total the cost per unit we can calculate. Then last lesson we have a discussion on marginal costing and absorption costing. So we can look around marginal, and we can say absorption costing. We discuss about activity based costing, we discuss about job costing, we discuss about standard costing. So these are all the and we had a discussion on process costing. Marginal costing is the cost of every successive unit where we can calculate the variable cost, and fixed cost is known as a periodic cost. Absorption cost, all the costs absorbed in the closing and opening inventories, and the production cost, that is the absorption cost, also known as the full cost. Activity-based costing, as the activity increase, the cost increase. Job costing, like the many. If you're a builder, each job you do the separate costing. Standard costing, what is your fix? What is your standard cost for one unit, and if you produce more units, you multiply. So it's quite similar processes. If process 1, process 2, process 3, we can calculate each level is a separate cost. Okay, that's all was in the during last lesson. Osama, if you have any question, please you can ask. Huh? So hope you can hear me. So today lesson really we looking costing system and financial ratio. So always good to be reflect what we know about the financial ratio. Financial ratios we use to measure the financial performance. So financial statement, what those are, how many statement we prepare in account. So these are the 4 statement international accounting standard board. According to the framework, we prepare the financial statement. Financial statement help to measure the financial performance of the company, and the statement of comprehensive income, or we call profit and loss or income statement. Second statement is a statement of financial position, also known as a balance sheet. We can call asset liabilities, and so these are 2 statements is quite, of course, all other statement are crucial as well. But if you want to see the profit or loss of the company and the performance in terms of how much sales, how much profit we have during the year, you can look around the statement, which is the statement of comprehensive income. Second statement is a statement of financial position. We can look around the asset, liabilities, and equity of the company, which is mean investment. Cash flow, we can look around the how much cash in and out from the business, and the statement of change in equity or equity statement. So that's how much shares we paid, what are the shares value, how much was the retained profit, the profit of the previous year we retained. So that's the key. Okay. So that's the key which we can look around in the financial statement when we measure the performance. So we have a conceptual framework, set the principle and the concept according to the International Accounting Standard Board. Believe they should be underlie the preparation and presentation. So financial statement should be true and fair. Should provide the financial information that help an entity to make the right decisions, and we can look around providing resources for entity. That's quite crucial, which we need to be look around. Okay, conceptual framework, going concern, the financial statement are prepared on the exemption that the entity will continue to operate for foreseeable future, no intention to liquidate, or the crucial scale of operations. Materiality. Materiality concept is called material concept. Accrual. What is accrual basis? So each year income and expenses should be recorded in that year. So if this credit sale is 100, this is the sale. Doesn't matter you receive the cash or you didn't receive the cash, but you should recognize that the sale, because like DFS sofas buy now and pay in 5 years in the UK. DFS sofa, normally people buy sofas on credit, furnitures on credit. So that's we can say the sale for the DFS and is a receivable. So we should record sales and receivable. Receivable is an asset, sales is, of course, is an income, and we can look around and we can minus the cost and we can say what is the profit. So we can Each year income and expenditures and the items should be reflected in the financial statement. That's quite crucial. Okay. Then qualitative characteristic use of the financial information. These are the quality should be all the relevant, capable, making decision, different decision include in materiality, faithful representation. It should be complete information, neutral information, free from error, and enhance these characteristic about financial statement. All the comparative figures, always good to be give 2 years financial information because people can compare. When we saying I own this asset, I should be have in my name. We can verify it actually is your asset you have in your warehouse. Timeline, so every 12 months we should prepare the financial statement end of year within 90 days. Understandability, the figures should be in a properly structured asset under asset liability. So asset is mean anything you own it, anything has the economics value is your asset. So financial statement, preparing the financial statement, we prepare under IS1. If because the reason international accounting standard 1. Because we look around, we can call statement of financial position, statement of profit and loss, comprehensive income, statement of chain equity. These are the 4 statement under IS, as we mentioned earlier. We need to prepare. If we look, the under IS, so we have a sale. We look around. What is your cost of sales? We can say sales revenue minus cost of sales, then is equal to gross profit. Then if you have a discount received is other income. If we have other expenses, overhead expenses, we minus, like we discuss about under costing, and we can say the profit we have, how much profit we have, like electricity distribution and all these are the expenses. Then we can say how much is the profit we have the company made during the year. Statement of financial position, it shows asset, non-current asset is a long-term asset. So we can look around, the tangible is a physical, intangible you can't see, like the goodwill is can be asset of the company, like building, plant, machinery is your asset, but intangible is mean you can't see it but still your asset. Sama, can you hear me okay? Yes, please, if you confirm.
Yes.
Okay, brilliant, thank you. Current asset is mean the short-term asset or the asset most liquid which we can convert into the cash. So if we add them all, that's called total asset. If I'll take out liability out of it, liability is a legal obligation by law to pay back. So asset less liability equal to net asset. Net asset figure is always equal to capital. Capital mean the investment, or we call equity. Equity means share. If it's a company, we call equity. If it's a normal like a sole traded partnership business, we call them so we call capital. So capital we brought previously, capital we introduced more investment. The profit for this year is less, drawing anything for personal use. So we can say what is your capital value is always equal to the net asset value. If you know net asset value, you know your capital value. So these all the financial statements. Financial position is a snapshot of the financial position of the company in terms of non-current asset, current asset, all being explained. So non-current asset, the long-term asset we can use more than a year. Current asset, most liquid asset. Non-current liability is a long-term liability, like a mortgage, like the bank loan. We're not settling in a year. It takes more than a year. Current liability, like overdraft, OD limit. So from the bank, that's short period of time, which is will carry on. And then we have accounting equation, asset minus liability is equal to net asset, and net asset equal to always capital. So that's all being explained, and that's quite crucial, which we can. So please, I included the link for you. If you copy those links, we can look around the financial statement. This is the link is quite of course previous years. We can find the next the financial statement of next company. So I'll quickly show you. That's quite good to look around. Or we call them annual accounts, which is absolutely fine. Pick up 2 words. Annual account or financial statement mean annual account. So if we look here, financial reports, yes. So we can find it there, annual reports like here. If we look within this report, it's all the snapshot of the next is of course bigger. So we'll see here consolidated means overall all the subsidiary and the major company, their statement is being consolidated. Under page 108, we've been given the income statement. So if I'll type here 108, sorry, 180, one or two page down, if we look further down, so we can find it. So if we look here, please, you will see here 52 weeks. The year end is 28 January, end of the Jan. That's 360 or 65 days operation. So these are the notes where we can find the detail where the income came from. Revenue, how much is previous year in 2023? How many million? 5034 million was. No, it went up to 55491 million. The cost them 3034.5 million. Other impairment, they have a losses due to the value of the asset being changed, and the total gross profit they have, this 2420 million. They have, the gross profit. Then they have other cost, distribution cost, which is an indirect expense. So we can look around. So after taxes and all adjustment, if we look there, 800 million, they have the profit this year, and the last year they have 710 million. So that's in the profit. If we look here, the earning per share, how much they paid, per share, the earning, so the earning per share was 573 pence per share, which is mean £5 and 73 pence. No, it went up to 661 pence. So it means £6 61 pence, so we can look around the dividend they paid on the shares. Is every share they paid £6. So we can look around then if we look at the balance sheet of the company, that was the profit and loss, is all explanation of detail. Then we have the non-current asset, what's happened, those is went up. This is a good indicator. If we look the total asset, current and non-current went up. We look the liability, if we minus all the asset, it's your net asset. So minus liability, the net asset figures you've been given. If you look, that's increase, which is a good indicator in 2024. And if we look the chain in equity, what's happened in equity figures, which is mean total capital, that's went up in, and we can look around the previous year, they just structure like here. So that was 11,1165, now is 1638, which is equal to our net asset figures. If I'll take you back to the 2024, you see their net asset figure, which is exactly the same figure, but it's been adjusted, in the, so if net asset, then consolidated the cash flow. So we can find it under cash flow. We have three activities: operating, financing, investing. Operating is day-to-day operation, how much money in and out from. So if we look the net, operating activity, what's happened, the cash position, 798 million was the cash, now is 1120 million was the cash. Under investing activity, the cash went out from the business, 271 million, and now it went out because they have invested more in buying assets. The cash went out from the business. Financing activity means borrowing money, so they have borrowed the money, the settled net financing activity money went out under this 721 million, and this year went out 663 million. So if we'll say the last year the net cash was negative figure, there wasn't during the year of the inflows and outflows 193.7. So this year we have 122 million positive cash flows. The opening balance of the cash flow last year was 199.9 million, which was quite, now if we look there, 27 opening balance, because very less opening balance was of the cash, because that's, the last year there was the more outflows than net cash inflow. So if we look, the cash position now is 124.3 million. The last year cash position was only 2.7 million. So it means our closing balance of the cash is being betterly. So we are strong company in terms of the cash. So if I look, take you back to the balance sheet, also shows cash. Cash is a asset, or we call cash and cash equivalent under the current asset. If we'll see here, you will see there 188 and other was, yes. So that's which we can look around cash and cash equivalent, anything we prepaid, which is also considered as the cash. So that's we been given an explanation of these also. And these, the financial statement quite good to look around. That's give you the overall picture. So I did one, you can compare with the Marks and Spencer and all exactly the same way. Okay, 2.2 is the recommend the CN evaluation, the financial statement and the ratio. Ratio is the relationship between two numbers, and we measure the performance. We use the financial ratios to measure the performance. So we look to the user of the financial statement. There are different users like employees, stakeholders, government, um, so managers, these are all, they can make the decision by looking the performance of the company. Financial ratios use the simple calculation based on the numbers and the set of numbers and the calculation. There are the limited use. Sometimes, yes, you have to interpret these. So we've been given the ratio. So if we look these, the ratios, all the formulas in the formula sheet available are Moodle page. Liquidity ratio mean anything convert into the cash, current asset divided by current liability. So we can look around. Profitability ratios is a profit, gross profit, profitability. So we can look around the profitability ratios. Financial position, what is the position of the company in terms of gearing? If you have a high debt and equity, it means how much debt we have, like bank loans and things, how much is money we have. Equity means the share you issue. Use of resources, the resources you have asset, how effectively you use to earn the profit. If you look on the next slide, you've been given all the possible formulas. So we can calculate the net return on capital employed, the profit from operation, which is given in the profit and loss, total equity figures you can find from the balance sheet, and the non-current liabilities, add them because we borrow money for the long period of time. Or you can calculate, any ratios. You can pick gross profit divided by revenue. Revenue means the sales, gross profit time by 100. How many percent this year and the last year? Inventory turnover. How quickly inventory being sold and generate the profit. 365 days is operation. How always good to be receivable days. In 30 days we receive money, and 90 days approximate if we pay money to our suppliers. So there will be a 60 days we always have a cash in account. So that's why we want to be change our term and condition to increase the cash flow, and we hold the cash end of the year so we can creatively we well manage credit control. So that's which we can look around. So these ratios quite good to compare the company performance. We have to interpret which we look now one of the companies. Okay, so these each ratios been explained: return on capital employed, profit from operation divided by, and that show the relationship between two things, and that's help to measure the performance of the company. Return on equity is mean the capital shares, how much return we have again, how much shares in circulation, and how much per share we earn. Percentage of the gross profit, how much gross profit we have, operating profit, how much we have. We can calculate the margin. Asset turnover, the asset we have, how much profit they generate, every pound worth of the asset. So these are all the ratios. Current ratios, current asset divided by current liability. Normally 2 pound worth of asset, 1 pound worth of liability is quite good. Current asset minus inventory, and current liabilities, which we can look around. That's the most liquid asset. The inventory turnover days show the rapidly business inventories are sold on the average, during period. So all being explained. Interpretation of the ratios in terms of gearing. If you drive in a high gear, if the ratios will come high, so it means the company is a high risk. And interest cover ratio, the money we are paying as a finance cost, as the interest, how much proportion of the profit which we are. If you paying you're earning profit, but all you paying towards your loan interest, so what you're earning really? You're earning nothing. So that's So we have two companies. One is called Anika and Papika. Their handouts is available on our Moodle page. I can show you as well. Anika and Papika are two companies. If you look, Anika, they have the gross profit is 16,200 and their sale was 36,000. So 16,200 divided by 36,000 times by 100. So because converting into the percentage, that was 45%, and Papika is 52%. So according to this, Papika's performance is better than Anika. Like uh, mm, you can do Marks and Spencer and next if you want to. So we can look at Anika's performance is better. Papika's performance is better than Anika's, which is if you take the difference, there is a 7.5%. They are well off. Okay, if you're investing in Paprika. So operating profit, the profit after meeting all the expenses before tax, that was 3240 divided by 36,000. That's 9%, but Paprika is 11 point. So Paprika profit is 2.5% is a higher. So according to these ratios, I suggest Paprika is a better. But when we look the gearing ratio, gearing is shows the risk, like if you drive in a high gate Java, if the ratio is a high, it means high risk. So 13.25, so we can debt divided by debt plus equity. That's the formula we use. And then 13.26% and Papika 71%. So if we look, the profit difference is only 7%, but if we look, the risk difference is good. So it's quite high difference. So that's huge difference we have to think about. So which one you have to invest? So Papika is more risky company than Anika. If you look the gearing, if just there are two formula, debt divided by equity. So we look, this is 15 and 245%. And if you look the interest cover, this is the interest they are paying on the loan is 11.6 time profit is a higher than the interest. So if because that company can easily afford to carry on paying interest on they borrow money, but this company their profit is only 3.1 times the higher. So if next year this profit drop, so this company maybe not afford to pay the debt, to the. So current asset tax ratio, current asset minus inventory. Inventory sometimes is less liquid because maybe people not willing to buy. Like if you have a Windows 98 CDs in your warehouse, so current liability. So we can look around. This was 1.22 because every £1 2 pen 22 pence of asset, £1 worth of liability. But this company is only 65 pence of asset against £1 worth of liability. So they have asset less liabilities more. So in that case, keep on these. We can decide now, we can propose recommendation 2.3, which company, based on the performance. We can look around other future strategy of the companies. We can overcome vertical different analysis of the company. We can look around the benchmark of the company, and then basis of this we can decide which one is. We can always good to be look around industry average. In industry, like in a food industry, people say it's a quite good money. That's why hotel, restaurant, bars, these increasing because their profit margin is. So you can look around the average. So these ratios shows, like before COVID, maybe ratios good, but then COVID happened, lockdown. So you have to look around the current and the future business strategy, current environment and the future strategy also indicators to be make the decision. So different people interested these ratios, investor interested to determine whether to hold or sell their shares, the potential investor, lender they want to give the lend or not, suppliers, customer, government is want to check, they are paying the right interest taxes or not, the public they really want to be what they contribute in the local economy. So according to our decision based on Anika's gross profit is a better, Papika's gross profit is a better, Papika's operating profit is a better, gearing ratio, Anika's less risky, Anika's interest cover less risky, asset test ratio is less risky. So based on all these, we suggest, it's good to be invest in Anika. Anika is less risky. I would advise you to invest in Anika's instead of Papika's. Papika is more risky company than Anika. So based on this, you can make the decision which company to invest and how much to invest. Any question there?
No, thank you.
Okay, so please, I included the link for you all if you want to be further reading, like liquidity ratio analysis, and that's quite good too. And further handouts, these is also available. Our Moodle page, please, follow any comment for Pika's question one, and the answer booklet also given and good to be look around the ratio analysis for Moodle. Okay, that's all from my end. Please, anyone have any question, you can drop me email. So today we discuss about four types of ratio: profitability, liquidity, use of resources, and gearing ratios. And we had a discussion four types of statement of comprehensive income, we call profit and loss; statement of financial position, also known as the balance sheet; statement of cash flow, shows in and outflow the cash; and statement of change in equity, how much dividend, how much. So that's all, from my end. So please, if you have any question, you can ask. Otherwise, we'll keep up to here. Thanks for attending, and
Thank
have
you.
thanks.